JCPenney is a company that we invested in that we knew on the way in was a much higher risk situation than a Canadian Pacific. So JCPenney, for those of you who are not familiar, is a 112-year-old American sort of iconic retailer that's certainly way past its prime. It probably peaked 25 or 30 years ago. Again, another example, you had James Cash Penney, who founded the company. He died, I think, in the early 70s. And there's a pretty good correlation between when the founder goes and when the company goes. And part of that has to do with governance, which is a topic I'm sure we'll get to. But the time we invested, JCPenney stock was down from $80 to about $20 a share. It was trading at about 4 times operating income. It had lots of assets lying around in the company that were non-core assets. It had a very bloated expense base. And it was generating very little sales per square foot. It was a very underachieving retailer. And part of that is the brand had become somewhat tired, and they had gone to a very highly discount-oriented model where they'd mark a dress at $40, and they wouldn't sell any at that price. And a week later, they'd mark it to $20, and they probably wouldn't sell many at that price. And then they would send you a coupon where you got $10 off, and then start to sell a few. And then if you used your credit card, you got $4 off, and if you bought this moment, you get another $5 off. And eventually, it was, $8 or whatever, and they sell a lot of them at that price. And the thesis was this company has actually still a brand, well, faded, restorable, and because they were created over the last 112 years, they actually own about 112 million square feet of some of the best real estate in the shopping mall, in the shopping real estate industry. But they own or have very long-term leaseholds at very low rents. And we said, look, this is a great platform to rebuild the company. And we bought a 16% stake in the company. I was invited to join the board. I joined the board with a friend who bought 10% along with us, so we owned together 26% of the company. We both joined the board. We were 2 of 11 directors. And the CEO was 64, and the board was very much focused on succession, as any board should be generally, but particularly when their CEO is in his mid-60s. And we helped the board with succession, and there was a candidate that kept surfacing as the best guy in retail. And this guy's name is Ron Johnson, and he had an ideal background. He didn't go to the Oxford Business School, but he went to Harvard Business School. And he graduated, he went to work for Mervyn's. His dream in life was to reinvent the department store. And Mervyn's was kind of a dying department store. It was acquired by Target. So he spent a few years at Mervyn's. He spent 10 or 11 years at Target, which is probably the best run US discount department store. And then he was hired by Steve Jobs to build the Apple Store from a blank sheet of paper. And he did an absolutely incredible job. And we said, look, you couldn't ask for a better background to do what we're trying to do here. Reinvent the department store. Combine the Apple customer store experience with kind of some of the Target brand excellence and cost management. And the problem was recruiting him. He was very happy living in Atherton, California. He had $400 million of restricted stock in Apple, $100 million of which he was going to lose if he left. And he had kids who were in 13, 15 years old, in the middle of their, at a time when parents don't like to move. But I managed to convince him to take the job. And he walked away from $100 million in restricted stock. We gave him $50 million to make up for it, but he still took a loss when he took the job. And then he invested $50 million in 7-year options that he bought with his own money that he couldn't sell for 6 years. So I thought this is the absolute perfect thing. We have the best guy, we've got a great platform at a really cheap price, we have the perfect alignment of incentives, and I thought, it's done.
But it didn't work.
But it didn't work. And so Ron got started in November of 2011. And he proceeded to make a series of changes, many of them very favorable. Among them, he took a very hard look at the cost structure and found about $1 billion that he could take out of the cost structure of the business. We took a hard look at all the non-core assets, and we monetized about $600 million of the non-core assets. So far, so good. And then he launched a business plan to convert the JCPenney store into basically a mini shopping mall, a Selfridges type model where there were a series of brands, each of which would have their own kind of presence in the store. And then you'd have a consolidated checkout with a wireless experience and sort of this Apple-like customer service experience. And he sold this idea to brands that heretofore wouldn't be willing to go into JCPenney. And the guy's very charismatic. It was a great idea. And he had a whole bunch of brands that he got from around the world who were excited about opening up inside JCPenney. And he went to work. But he made one very significant strategic mistake. This whole notion of what he almost called fraudulent pricing, this overpricing an item and then marking it down and coupons. He said, look, this is a waste of time. Let's just market at the price. The consumer knows the fair price. Because when you looked at those $40 dresses and $40 shirts, they all sold it for something like $12.30 on average, and very little sold at any other price. He said, let's just market at $12. The consumer understands value. We can save a huge amount of, the company had spent an enormous amount of man hours actually changing signs. If you think about how often they're constantly repricing and reticketing and changing signs, the stores look really cluttered. And, it sounded like a brilliant idea. And the Apple experience was not about testing. So instead of trying this out in 1 or 2 stores or in a region, he rolled it out across the country. And it failed. And the customer who had become accustomed to getting coupons in their Sunday circular, all of a sudden the coupons weren't there, and so they decided not to come. And we lost about 1/3 of our customers after about 12 months. And the great thing about a retail business, if you get it right, is this business has enormous operating leverage, right? Because you've got a substantial fixed cost base, but once you start generating additional sales, it almost all drops a lot of it drops to the bottom line. Well, only problem with leverage, as you learn in business schools, it works in reverse. And so all of a sudden the company was losing huge amounts of money after having spent a ton of money on capital, rebuilding and redesigning these stores. And we found ourselves in a turnaround 15 months after he was hired. And we had to replace him.